Welcome back to Investing Talk Podcast.
It's great to be back.
Okay, look, I'm not going to sugarcoat this. We need to get straight into the mess.
There's a lot to unpack.
Yesterday was, chaotic feels like a massive understatement. It was an absolute bloodbath out there.
It really was.
If you were watching your portfolio, specifically the healthcare sector, you probably needed a stiff drink by, 2.0 p.m.?
Yeah.
We saw volatility we just haven't seen in years.
For a company of this size, it was a historic move.
And one of the absolute titans of the industry, the stock that usually feels as safe and boring as a government bond, just took a nosedive that has everyone asking if the sky is falling.
Well, you almost never see moves like that. And
Yeah.
usually, a move of that magnitude means one of two things.
Right.
Either the business model is fundamentally broken and the market finally woke up, or the market has completely lost its mind.
Panic.
Completely panicked and created a massive opportunity for the rest of us.
Exactly. And that is the question on everyone's mind right now.
Yeah.
Is the bleeding over, or is this just the first cut of 1,000? So lay it out for us. What are we looking at today?
Today, we are looking squarely at UnitedHealth Group. And frankly, this is a classic blood in the streets scenario. We are talking about a blue chip behemoth that has panicked investors just running for the exit screaming, sell at any price.
I see it on the chart.
But our mission today is to look past that panic. We need to, pop the hood and see if the underlying machinery is actually broken or if it's potentially printing more money than ever before.
I do love a good contrarian take, you know that.
Yeah.
But looking at these charts, I've got some serious skepticism.
Yeah.
It looks ugly. Real ugly.
It does.
But before we start tearing this apart, as usual, before we start, subscribe, like, and comment to this video to support the show. It really helps the algorithm show this content to more people.
Absolutely. That engagement helps us keep the lights on and keep bringing you this research.
All right, let's unpack this. We need to look at the numbers because the stock price is telling us one story, a horror story. But I want to know if the business reality justifies that kind of panic. So let's start with the fundamentals. What did they actually report?
So on the surface, if you just look at the sheer scale of this business, it's mind-boggling. Yesterday, January 27th, they reported their full year 2025 performance.
And the number was?
Consolidated revenues hit $447.6 billion.
Hold on, let me just pause there. Nearly $500 billion.
Correct. $500 billion. To put that in perspective for you, that revenue figure is larger than the GDP of countries like Austria or Egypt.
Wow.
And that represents a 12% increase year over year from 2024. But here's where it gets really interesting.
Okay.
This is the key nuance most people miss. It's not just about selling insurance plans anymore. The real growth engine here is Optum Rx.
That's their pharmacy services arm, right? The drug benefit side.
Exactly. But think bigger. Optum Rx brought in $154.7 billion on its own.
Just that division.
It's just that division. And it's up 16%. So when you think about UnitedHealth, you have to stop thinking of them as just an insurance company. Think of them as a pharmacy and health services giant that just happens to also sell insurance plans.
And that's where the growth is coming from.
That pharmacy growth is driving the bus right now. It's growing significantly faster than the insurance side.
Okay, that is a massive number for sure. But why does that distinction matter to the person holding the stock? Why should I care if the money comes from pills or premiums?
Because of the moat. This feeds into their integrated ecosystem.
Explain that.
They have UnitedHealthcare, which collects the premiums, and then they have Optum, which provides the care, the tech, and the drugs. It creates this incredibly sticky web.
So they're paying themselves.
Essentially, yes. If you're in their system, they are capturing the dollar at every single stage of your healthcare journey. Optum Health alone added 650,000 new patients in 2025.
That's a small city.
It's a small city's worth of people entering their ecosystem, and once they're in, they are very hard to lose.
Okay, I see the scale. I can't argue with $500 billion in revenue or that vertical integration. But I have to play the skeptic here.
I expect you to.
Because clearly the market hated something. You don't drop like a stone because you made $500 billion. And I think I know what the problem is. Let's talk about the margins.
Yeah.
Specifically, the medical care ratio, or MCR.
The MCR is definitely the sore spot. That's where the pain is.
Sore spot feels polite. It looks like an open wound. It rose to 88.9% in 2025.
It did.
For listeners who don't follow this stuff daily, let's be clear. The MCR is the percentage of your premium dollars that go right back out the door to pay for medical bills.
Right.
A higher number is bad. It means for every dollar they collect, they're spending almost 89 cents on patient care. That was up from 85.5% in 2024. That's a massive squeeze.
It's a huge squeeze. You're right. There's no dodging that.
And it's not just bad luck, is it? It feels structural. We're seeing funding reductions from CMS, the Centers for Medicare and Medicaid Services, and hits from the Inflation Reduction Act.
The government is tightening the purse strings.
Right. The government is basically saying, we aren't going to pay you as much. So if your costs are up and the government pays you less, that 89 cents could easily become 95 cents. At what point does the business model just break?
And that is the headline risk, yes.
Hmm?
The margin for error is definitely getting thinner. But you have to look at how management is responding.
Well, let's look at their response then, because their guidance for next year actually confused me. They just made $447.6 billion. But their guidance for 2026 says they project revenues exceeding $439.0 billion. Wait a minute. Why is the top line going down? Are they shrinking? That doesn't sound like a growth story to me. That sounds like a company in retreat.
I'm glad you caught that. It's a crucial detail that a lot of the knee-jerk headlines missed. Yes, the top-line guidance looks conservative, maybe even flat to down.
Right.
But look at the bottom line. That's where the story changes completely. Despite that revenue dip, they are guiding for earnings from operations to jump to over $24 billion.
Revenue down, but earnings are going up.
Significantly up. From $19.0 in 2025 to over $24.0 in 2026. And they're targeting an adjusted EPS of greater than $17.75.
Okay, how do you pull that off? How do you make more money while selling less? That sounds like financial engineering.
It's efficiency and focus. They are aggressively trimming the fat. For one, they have a $1 billion tech-driven savings target by 2026.
The old AI will save us line. I feel like every CEO says that lately. Is there anything tangible there?
I mean, it is real money in this case because of the sheer volume they process. Shaving pennies off billions of claims with automation adds up to hundreds of millions.
Okay, fair.
But more tangibly, they're making strategic sales. They're selling Banmedica, their South American operation, for about $1 billion.
Getting at a non-core market.
Exactly. So that revenue dip you see, that's likely them shedding lower margin revenue to focus on the profitable stuff right here in the U.S.
So it's addition by subtraction, dropping the heavy baggage to run faster.
That's it. And look at the cash flow. It's incredibly stable. $19.7 billion in operating cash flow in 2025. They expect over $18.0 billion in 2026. This isn't a company in distress.
It's a company re-optimizing.
Precisely.
All right, so they are tightening the belt, focusing on profits over empire building. I can respect that logic. But let's shift gears to what the stock is actually doing. We need to talk technicals. Because re-optimizing sounds nice in a boardroom.
But the chart looks like a crime scene.
Exactly. It was a violent reaction. Let's talk about the crash. After those earnings dropped, the stock didn't just slide. It fell off a cliff.
A 19% drop.
19% in one day. For a company this size, that wipes out tens of billions in market cap instantly. That's more value than most companies are even worth.
And it dragged the whole sector down with it, too, as a contagion.
Yeah, Humana, CVS, they all took a beating. It was like investors just threw the baby out with the bathwater. If you look at the chart, it's just a straight line down. It looks broken.
But that is exactly where the opportunity might be.
Go on, because catching a falling knife usually costs you a finger. Why is this different?
When you see a gap down like that, a huge drop triggered by a surprise, it almost always leads to an oversold state. It's just pure panic selling. It's emotion, not math.
Okay.
But more importantly, look at the volume. We saw massive surges in trading volume during that drop. In technical analysis, we call this capitulation.
Define that for us.
Capitulation is when the last of the panicked sellers finally give up. They're just puking the stock up at any price to get out and stop the pain. They don't care about value anymore.
They just want out.
They just want the red to stop flashing. It's a total washout. And once everyone who wants to sell has sold,
there's no one left to push the price down.
Exactly. The selling pressure evaporates. If the repricing discipline that management talked about actually takes hold, the stock is technically set up for a massive bounce from these levels.
The sellers are just exhausted.
They are.
Okay, so we have a fundamental case for efficiency and a technical case for an oversold bounce. But let's look at sentiment. What's the mood out there? Because from where I sit, reading the reports, it looks pretty grim.
It's not pretty. You want to take us through the data?
Yeah, I pulled the sentiment scores from Alpha Vantage, and it is ugly. The ticker sentiment score is hovering around negative -0.48.
Wow.
For context, anything below -0.15 is considered bearish. This isn't just bearish. This is deep in the red. This is everyone hates this stock territory.
That's extremely negative. That's usually contrarian gold.
And I checked the headlines. 5 major outlets, Morningstar, Barron's, Yahoo. 0 out of 5 were bullish. Not a single one. The entire media narrative right now is just fear.
And we know what's driving that fear. It's not just the MCR.
Right, it's the CMS proposal.
Yeah.
The Centers for Medicare and Medicaid Services proposed a 0.09% rate hike for Medicare Advantage in 2027.
0.09%.
Basically zero. Let's be real. With inflation running at 2 or 3%, a 0.09% hike is a massive pay cut in real terms. The market was expecting something in the 4 to 6% range.
A huge miss.
It's like expecting a nice bonus and getting a $5 gift card instead.
It is a shock, absolutely. And that's why the sentiment is so bad. But this is where I take the contrarian view.
Of course you do. But explain why. If the government is cutting their pay, why be bullish?
Because you have to look at who's leaving and who's staying. Yes, the sentiment is terrible. We know Michael Burry, the big short guy, he liquidated his stake.
Which usually signals, get out now. If Burry is running, shouldn't we be?
On the surface, yes. But look at what he bought instead. He moved into Molina.
Which is more Medicaid-focused.
Right. So he stayed in the healthcare sector. He just switched lanes to a different government program. He didn't abandon the idea of healthcare. He just rotated. That tells me the sector isn't dead.
Okay, so Burry is out, but he's still playing the game. Who is staying?
If you look at the institutional 13F filings, we're not seeing a mass exodus from the core long-term holders yet. The Vanguards, the BlackRocks, the guys who hold for decades, they tend to hold through this kind of noise.
So the tourists left, but the locals are staying put.
That's a great way to put it. And listen to the management team on the earnings call. Did they sound panicked to you?
They sounded surprisingly calm, almost robotic.
Exactly. They emphasized that 2/3 of their 2026 EPS will come in the first half of the year. They have visibility. They aren't guessing. That confidence is the complete opposite of the media fear.
Okay, but confidence doesn't pay the bills if the government cuts your funding. Let's talk risk. Because if you're telling me to buy this dip, I need to know the worst-case scenario.
Let's lay out the bear case.
The primary risk is that 0.09% rate hike. If that sticks for 2027, this isn't a one-time hit. This crushes margins permanently. You can't efficiency your way out of a 5% revenue gap forever.
That's a fair point. If the regulatory environment stays hostile for years, the ceiling for growth is definitely lowered.
And that medical care ratio, again, 88.9%. That leaves so little room for error. If we get a bad flu season, a new pandemic variant, or heck, just more old people going to the doctor,
Utilization rates go up.
and that 88.9% becomes 90% or 91%, suddenly your profits just vanish. They're walking a tightrope without a net.
It's a tightrope, I agree. And the political risk is real. The macro trend is that the government is trying to pay less. The days of easy money are over.
Exactly. So why catch this falling knife? Why step in front of this train? It feels like gambling.
Because I believe the 19% drop has already priced in those risks.
Priced in. The favorite phrase of the optimist. What does that actually mean here?
It means the market is currently assuming the worst-case scenario. That the rate hike sticks, that they can't cut costs, that margins collapse. The stock is trading as if disaster is guaranteed.
So if reality is even slightly better than disaster.
The stock goes up, the bar is set incredibly low,
No.
They just have to not die. And remember the diversification. Remember Optum RX. It's growing at 16%. They aren't just an insurance company anymore. If the insurance side gets squeezed, they have a massive health services giant to lean on.
A buffer.
A huge buffer that a pure play insurer like Humana just doesn't have.
That does provide some stability, I'll grant you that.
And look at the calendar. We have a catalyst coming up. Q1 2026 earnings will be out in April. Management guided for an 88.8% MCR, if they hit that target.
The prove it moment.
It's the prove it moment. If they show they can control costs even in this environment, the stock re-rates higher immediately. And don't forget the macro environment. We're likely looking at interest rate cuts.
Which helps a company with massive free cash flow.
Exactly. It makes their debt cheaper, lets them buy back shares more aggressively. It's a tailwind they haven't had in a while.
Okay, let's wrap this up. I'm still seeing a falling knife with the government squeezing their margins. It feels risky, but I know you've got a score for us.
I do, and despite the scary charts and the gloomy headlines, my verdict is bullish. I'm giving this an 8 out of 10.
An 8. That is incredibly high given everything we just discussed.
It's aggressive, but the fundamentals just contradict the panic. You have massive revenue, over $24 billion in operating earnings projected, and EPS over $17.75. The moat is intact. The sell-off was an emotional overreaction.
This is a blue chip on sale.
That's how I see
So
it.
what's the strategy for the listener?
This is a classic buy-the-dip entry. You're buying $1 for 80 cents because everyone else is scared. It's a multi-year hold into the 2026 growth story. The target is a rebound as they get back to that 3.6% net margin they're aiming for.
All right, so the expert view is ignore the panic, look at the cash flow, and trust the moat. It's definitely a bold call. Fortune favors the bold, as they say.
But sometimes it also favors the cautious. We shall see.
Indeed we shall. That's all we have time for today. Thank you for tuning in. If you found this analysis helpful, please hit that subscribe button, leave us a like, and let us know in the comments. Are you buying the dip, or are you staying far away?
Can't wait to read the comments on this one.
We'll see you in the next one.